Hello, friends. Hope you are safe and strong. So, in continuation to our earlier session on call and put options, let us know a little more about call and put options. So, first of all, we are talking about what is moneyness of option. So, moneyness option is described in terms of the difference between the strike price and the market price of a particular stock. So suppose you have uh, bought a particular call option at a particular strike price, which is eventually found less than the market price. So you will not be exercising your call options, right? So if we are talking of call options, that will be a case where will we call which we call as out of the money. If both are equal, strike price is equal to market price, we call it at the money. And if it happens that the market price has gone beyond the you know strike price, then you will exercise that call option, and that will become your in the money situation. So out of the money, in at the money, and in the money situation. So what it depends upon is intrinsic value. So what is the intrinsic value? This is the difference between this strike price and the market price of that particular stock. So intrinsic value for a call option, in case strike price is less than the market price, uh, is positive, right? If the strike price is more than the market price, then you are not going to buy that particular stock at a higher strike price. So you will eventually buy it from the market. So in that case, the intrinsic value of that particular call option will be zero, right? So this was about intrinsic value. Now, how exchange rate impacts a particular person. Suppose there's an importer who is importing chemicals from Germany, right? Chemicals from Germany. Now, this fellow has sold on credit, has bought on credit the chemicals, but he has to pay in euros after say 1 month, and he expects that rupee is going to depreciate and euro is going to appreciate, and thus for the same amount of say 1 million euros, he's going to uh, dole out higher and higher amount of rupees because rupee has weakened. So his natural position, because he has to buy euros in future, so this is his natural position, and the hedging strategy will be to have a forward contract, right? So in spot market, his situation is long in euros, but in the options market, right? In the options market, in the futures market, his hedging strategy is short in euros, right? Okay. Similarly, another example in contrast to this is mango exporter. So this mango exporter is it has exported some some mangoes to Dubai, right? And he has to receive dirhams. What he expects, what he's afraid of, is that rupee may appreciate and dirham may depreciate. So same 1 million dirham that he's going to receive is going to give him less and less of rupees. So he'll be at a net loss. So what he desires, he desires to uh, you know uh, he desires to protect himself, and this he is going to do with a long call, right? With a long call, he will have a long call in dirham, right? So that if even if the price relative to the rupee, uh, dirham becomes strong, dirham becomes weaker, rupee becomes stronger, then also he will be shelling out not that much. He then also he'll be getting approximately the same amount of rupees that he was earlier going to expect. But his natural position, his spot position is short. Hedging strategy is long, right? Okay, so why long? Because when he's going to buy a call option in dirham, say in exchange market, so in terms of sorry, it paused. Me bring it again. Yeah. So in terms of rupees, so suppose he is getting 1 million dirham after 1 month, and that 1 million dirham is going to give him lesser of the rupees. So he has made a long call in dirham. That means if the price of the dirham goes up compared to rupees, he is entitled to buy dirham at the same old rupee price, right? So this is a way uh, he can get almost the same amount of rupees minus the premium that he has to pay for this long call, right? Now, importer is facing an upside risk and mango exporter is facing a downside risk. For upside risk, you have a short strategy. For downside risk, you have a long strategy, right? Okay, let us move ahead. Okay, so here we are discussing about the expectations. So what about expectations? So when we say expectations, a call buyer is always bullish. He is expecting the market price to go up, and call writer is always bearish. In contrast to it, the put buyer is always bearish and a put writer is always bullish, because put writer expects that the stock price will go up, right? And this is why he has bought a put option, right? Because he's wrote a put option, because if today the price is P1 and tomorrow the price becomes P2, then the put option buyer will not exercise this and he will earn the premium, right? So this is his expectation, of bullish expectation in case of a put writer. Now, what is the difference between American option and European option? In case of American option, it can be exercised anytime, right? Anytime during the period of the option. It can be 1 week, it can be 1 month, any time during that period. But in case of European, only at the expiry date, only at the expiry date of the option you can exercise it. American options may result into delivery, physical delivery of the stock, but European options are always, squared off. They're settled for the difference between the market price and the strike price. What motivates a call buyer to buy a call? He wants to earn a speculative profit. What speculative profit? His gain can be infinite. How come? We'll see in the payoff diagram later on. That's called leverage. So compared to uh, 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 options like short, sell, or in case of call buyer, you compare it with the stock long position, right? So if a market price of the stock is with time is expected to go up like this, I can buy a stock, make some profit, but I can, buy a call also, and then also I can make that profit. But the profit percentage in case of a call is higher. That is speculative profit, and that's because of the leverage. That's because of the leverage. You may want to ensure the against price rise when you want to say invest your mutual fund money or retirement money into stock market. So that's also one of the motivation for call buyer. He wants to limit his losses. So when we say the profits can be infinite, the losses are limited, right? Unlike in a stock buying option where the stock price goes, see, you get 100% loss. But same is not the case with call option. We'll see in the payoff graph. It can be used to hedging. We'll discuss hedging strategies later in this lecture. Now, uh, what motivates a call writer? Call writer is always, whether it is a put writer or a call writer, is always, call writer. Call writer is always looking for, all writers, whether it is a call writer or a put writer, they are always looking for premium. They also want to have something called covered call writing, right? So we'll discuss about it. And what motivates a put buyer? So we have seen the motivation of the call buyer. We have seen the motivation call writer. What motivates a put buyer? Put buyer is again like call option buyer can be seeking to looking forward to speculative profits, right? Here gain will not be infinite, but they will be large. And also the loss is finite and it can be used for hedging also. Coming to the put writer's motivation. So in case of put writer, he or she wants to earn a premium, right? She tries to buy stock at a lower price and cash secured put. So how cash secured put works is something like this, that suppose you have a stock which is having a market price of $60. This price, kind of falls to $57 in the market, and you have written a put, right? You've written a put, and you know uh, uh, so when you have written a put, you will have to sell it at $60 to the buyer of that put, but then you get some premium also. So when this premium is averaged out, you get that your actual stock, when you compare the cash flow, cash in, cash out position, you see that it is a cash secured put in which you actually lower the effective price of the stock that you have bought, okay, which gets 55. Now, if you compare buying put versus short selling, we compare buying call with long stock, and we compare buying put with a short sell. So in what is the advantage when you buy put against when you do a short selling? So in short selling, if market price goes up, you have to deposit margin with the broker, right? But in case of put, there is no such worry. You have bought a put, you have paid the premium, and you forget about everything. So there's no margin worries here. In case of put, the loss is finite, but in case of short sell, it can be infinite. Suppose you have sold short and in anticipation that the market price will fall, and market price goes to infinite, then you are losing at infinite, right? Because you will have to pay back somebody those particular stock at that infinite market price. Third thing is that sometimes you have to panic cover in case of stock prices rising, and it is natural to panic cover in case of stock prices is rising from point A to point B, but then you have already covered by depositing more margin, and next day the stock price suddenly falls down, right? So in that case, you will not be able to take that advantage of point C. A to B, you lost, but when there was an opportunity to gain from B to C, you could not gain. In case of put, you can do that. In case of put, you can do that because there's no jhanjat of this margin deposition. Now, what motivates a put writer? So you can see what motivates. Okay, we have already discussed earning the premium and to hedge a short sell and the cash secured put. So it got a repetition. Okay, in options, what happened? Writer only deposits the margin. Buyer doesn't have to, whether it is a call or put, buyer doesn't have to deposit any margin. Writer has to deposit any margin, and if the margin drops, he may have to top up the margin also. Now, this is the most important part of this session, which is called payoff charts. So when you talk about the payoff charts, uh, I think we'll discuss the payoff charts in the next video.